Hi, welcome to our panel on ESG applications in structured finance. I'm Jennifer Wolf, and I cover ABS and investor policy at SFA. And myself and the whole team at SFA has been really excited beginning midway through last year to start working on the topic of ESG among our members. A very hot topic, as I'm sure, and everyone who's been at the conference for the last day or so can attest to. So I'm also delighted to be here with this panel of speakers who bring their unique experiences and perspectives to the discussion on ESG. So let's do a quick round of introductions, and then I'd like to give each of the panelists an opportunity to say a little bit more about their own roles and their own firms' strategies and approaches to ESG. So to my left is Jim Callahan, principal at Pentalpha Global Advisors. Next to him, Benjamin Cohen, CEO and founder of T-Rex. And we have Luba Kim Reynolds, part of the multifamily capital markets investor relations team at Freddie Mac. Ash Parekh, structured products portfolio manager at Nuveen. And finally, Moog Sadakopan, head of CLO structuring at RBC Capital Markets. So Jim, would you lead off the group and share with the audience a little bit more detail about your firm and your view on ESG?
Sure. Can you all hear me? Okay. So we're the governance folks. We've been hired on about $250 billion of deals to watch over various aspects of the deals, whether it be on the default servicing, collection, and oversight side, or whether or not we are doing something in terms of rep and warranty enforcement. We're basically in 5 asset sectors: CMBS, RMBS, ABS, CLOs, and structured corporate. So we have the benefit of seeing about 6 to 12 deals a month. That is sort of Wall Street's newest invention in those segments, and our job is to watch over it.
Great, thanks. Benji?
T-Rex is a financial technology company that focuses on complex markets, namely esoteric ABS and broader structured credit markets. And we provide an analytics platform that's used for valuation, risk analysis, structuring, and does so in a way that allows those investments to be much more transparent throughout the life cycle of an asset, and ultimately as that asset becomes an investment. We've had a very big focus and an initial focus on renewable energy markets and in creating standardization and centralization of the data in those markets, which is now quite applicable to the broader ESG investment space.
Hi, everyone. First of all, I want to say this is really exciting to see that many people on Tuesday after lunchtime on the ESG panel. And I'm almost a popular person right now in my company. 2 years ago, when we were putting together our first green bond securitization, annoying, that was the word that would describe me. So it's really great to see the transformation. And Freddie Mac, multifamily, one of 2 agencies. So we are agency CMBS. And last year we issued our 2 green bond securitizations, about $1 billion. And then we also in the market with a few PCs. So altogether $2 billion worth of green bonds. And but financed to date since 2016, $59 billion worth of green loans business.
Hi, everyone. Nuveen is a large global asset manager with over $1 trillion in AUM. Within that, the fixed income area is several hundred billion. We have a pretty large structured products platform that covers just about every type of structured product that's out there, both public and private. Within that, and also at our firm, we have a well-functioning and growing responsible investing platform, as well as the considerations for ESG that happen on the trading desk and on the credit teams. So generally, I would say that there's a few different areas where the thought and the thinking on this particular topic comes to the forefront and into the investment process.
Everyone, Mook from RBC. I had the CLO structuring effort there. RBC is obviously a big investment bank with presence globally, based out of Canada primarily. One of the things about RBC is that we've made a firm commitment to being a leader in the ESG and sustainability front. One of the ways we've manifested that is the creation of a dedicated sustainability finance team in Toronto that's responsible for incorporating ESG factors across all of our core businesses globally, and also for providing solutions and advice for institutional and corporate clients. One of the other ways we've shown our commitment is committing to providing about $100 billion of CAD and sustainable financing by the end of 2025. We're about $25 billion or so through that goal already, so we're on track for that. On the back of that, specifically as it relates to loans and CLOs, our team's been working very closely with that team to basically identify investors in the US, Canada, and in Europe that are prioritizing ESG into their investment approach, and basically figuring out how we can address that need via the context of loans and CLOs. So that's been something that we've been working on very closely with them.
Great, thank you all. So I just want to let the audience know some of the topics that we'll be touching on in our conversation today before we get started. We'll talk first about what investors are seeking in the securitization landscape from an ESG investment. We'll talk about the current state of play in our market for ESG from a number of different perspectives. We'll talk about opportunities for further growth. We'll talk about sort of gaps and challenges for uptake for ESG engagement in our market. And we'll also close out talking a little bit about data and standardization, which is a topic that has, and a theme that has emerged and was touched on in the two panels on ESG that we had on Sunday, which hopefully some of you also were able to attend. So before we get started, I just wanted to share a few interesting statistics on ESG to sort of set the stage for the conversation. So obviously, as has been discussed, ESG is the hot topic this year and has been increasingly so. A couple of interesting stats I wanted to share. In 2019, ESG net fund inflows quadrupled their 2018 levels, rising to $20.6 billion from $5 billion the previous year. According to a recent Morgan Stanley survey of investors, 85% of retail investors are now interested in sustainable investing, which is up from 70% 5 years ago. And from the millennial generation, that number is even higher, north of 90%. So given this increased interest more broadly in ESG, it's certainly no surprise that there's significant interest in the structured finance market, not only on factors and analysis, but in certainly the rating agencies developing their own frameworks for how to assess ESG impact in ratings across our market. For SFA's part, in recognition of this continued increased interest, we've launched a task force to assess what we as a trade association, how we can engage with our members to encourage further uptake and hopefully provide some standardization and market standards for ESG within our market. As folks have highlighted over the course of the last few months, that is of great interest and desired by the market. And we're in the early stages of that. So we have seated a steering committee to lead our ESG task force, and that steering committee has, at this point, identified a couple of work streams that we'll be undertaking with the industry. The ESG task force is open to every SFA member in the industry, so it's a broad effort, and we want as much input from all perspectives as we can get. The first deliverable will be launching a market survey to assess the current state of play, the current state of engagement across the industry in ESG, and then we'll move toward progressing on a deliverable related to data standardization, and then potentially down the line, even hopefully developing some sort of disclosure framework if that's achievable. So that's what we're trying to do at SFA, so we look forward to all sort of interest and feedback that you all as members will have for the work we'll undertake. So with that, in order to kick off our discussion here of applications for ESG within our market, I'd like to turn it over to Ash to share his perspectives on what investors are seeking from securitization investments in ESG.
Sure. I would say, let me just go a little bit further back and to kind of, first, it's almost makes you sit up straight in your chair when you think about how quickly this particular topic has come up, you know, in terms of the number of things that people want to discuss and where this sits on the list. But at Nuveen, I would say that the origins of kind of where we've come from on the ESG topic and the impact investing topic, I think in structured products at least, the thinking comes out of what's originally started as a impact investing idea, meaning what are the trades that I can do where I can have a measurable impact? What are the trades that I can do where the sponsor is going to give me the information that I need? That tends to be a more narrow window. And then over time, as client inquiries have come in and they've asked us, what about this, what about that? They're looking for, generally speaking, some kind of systematic way to assess what the different types of risks are as it relates to the E, the S, and the G. So that's an evolution of thinking from just the straightforward impact investing. How many solar panels are on this roof? How many water heaters got installed here? That kind of thing, to a more, a more of a nuanced view on what's the E and the S and the G doing individually, separately in each individual trade that you're doing. So, in terms of where we are, and where the industry is, I think, is responding to client inquiries and coming up with a way. Everybody's kind of coming up with their own way to assess those risks based on what clients are looking for. So we're kind of in the formative stages right now as these inquiries come in and we start to crystallize exactly what this is going to look and feel like across the industry, and then for each individual asset manager as well, based on what their clients are looking for.
Cool. Could you say a little bit about the quantitative framework that you're working on?
Sure. I don't know that in the end we'll come up with, at least at Nuveen, it's not a foregone conclusion that what we're going to come up with is going to be 100% quantitative in nature. I think we've seen some other asset managers come up with things that are a little bit more quantitative, very specific scores. They have, there's a lot of precision there. I'm not sure that structured products in general is quite yet to the point where we can put specific numbers on everything, because it's an information gathering exercise as well. But in general, I would say you can start to think of things as who's leading in certain categories and who's lagging in certain categories, and then you can kind of take it from there. I don't know that you can end up with a specific number, though.
Could you talk a little bit about the challenges of scarcity of assets in the marketplace and fulfilling your clients' demand?
Yeah. The interesting thing about this particular topic is that a lot of what allows you to differentiate one credit from another, one platform from another on these criteria is just the ability to get the information you need so that you can differentiate credit A from credit B. Without the information, you don't have enough to kind of say this one is a plus in this category, this one's a minus in this category. So I would say the initial thought on this particular topic is that the first trades you're going to do actually already exist. It's just a matter of getting the information so that you can prove it out and show to your clients that these are the trades that are kind of meeting the criteria that you're putting in front of us and that we're agreeing to, and here's why, because we get this information and we can show you how.
Great, that's really helpful to understand that that's the way to look at it. I meant to say this at the start, but our panelists have wanted me to encourage the audience, instead of just holding all questions to the end, if folks want to interrupt our conversation and ask a question to a specific point that one of our panelists has made, feel free to raise your hand or jump up and down in your chairs so that I see you. And we'd love for this panel to be organic and conversational, so just let us know. So I wanted to shift the perspective here from the investor perspective and look at the perspective of from the asset origination and issuer standpoint. Luba, could you walk us through what Freddie Mac's been doing in your program and all of the details and what that journey's been like?
Yeah, absolutely. And I'm sure there's some, I think what I would like to share kind of like an issuer's perspective, and I'm sure there are a few issuers in the room who has been thinking to issue something on the impact side or did recently. Congratulations if you did. It was not an easy undertaking, by no means. And kind of like going back a few years ago to my prior comment where I was a very annoying person, it's kind of like you see this growing demand and opportunity, and Freddie Mac is one of the agencies, and the core mission of both agencies is affordable housing. So by every definition, everything that we issue should be already impactful. And yet, when we were looking at the list of our investors, there was not quite a lot of impact investors there, or yet they were expressing that, yes, we need, we like your paper, but we need some kind of a more robust framework because there's actually standards already exist, green bond principle standards, social sustainability, so all of that exists. So what we were going back to our investors was like, well, can you please give us a recipe and we'll make you a pie that, you know, maybe will be like, will fit what you're looking for. And what we realized that investors themselves are still in this process of figuring out what they're looking for, what their internal framework is, and what impact it actually means. So we took it back to the lab and we looked closely. So we already started in 2016 originating green loans where we were encouraging borrowers to do certain energy or water efficiency at the property. So what we decided to do is actually pull those assets together and concentrate on our workforce housing loans, which to sort of highlight not just an environmental impact, but social impact side of our business. So we pulled those together. We were in the market with our 2 green bond securitizations last year. It was received very well. We saw at least 5 to 7 new investors who has not purchased our agency CMBS paper to date, and they got in and they loved the deal because I think this is a big potential in structured products in general to be in this impact space and investors starting to accept us. So very encouraging.
Was there anything about the investor appetite that surprised you, or anything you have sort of learned over the course of the life of the program that caused you to make adjustments, either to structure or collateral or anything like that?
So I would say like one of kind of like surprising lessons is that some of the investors who were just not ready necessarily with their internal framework to really say what ESG or impact really means to them, they said, we love the positive impact story of your deal. It's almost like feel-good bonds that we're going to buy and we're going to put in our portfolio and kind of wait and see while we're going to develop this framework. So it's taking a step further, and we saw a lot of demand. We definitely want to try to concentrate on the social impact side, which is lagging behind green. So we will be hopefully in the market very soon with more social impact transactions. Mm-hmm.
Great, thank you. Benji, can I turn it to you to share with the audience sort of what you've seen over the recent past in terms of structural developments within, you know, various sectors or asset classes on the ESG front?
Sure. So to pull from both Ash and Luba, this is, ESG is not new, but the pervasiveness of the demand for ESG, especially in fixed income markets, is somewhat new. And so then the question is, what are we going to report on? What are going to be the standardizable metrics? And how are we going to quantify as many of those as possible? And so I'll give a couple examples, and there are no answers yet, as these two have both talked about, especially when you talk about a positive impact story, which is a subjective binary thing, as opposed to something that is quantifiable, like you have with credit metrics. And so there was a municipal bond that was issued by Miami, and I think that there are a few people who disagree that Miami is going to be more underwater than it is today at some point in the future. But then the question is it going to be a foot underwater? Is it going to be 10 feet underwater? Is that going to be in 3 years, or is it going to be in 10 years? And we can put risk factors around each of those. You can put probabilities around each of those, and then begin to quantify that. The other piece of it is, or the corresponding piece is, what is Miami's use of proceeds going to be out of that general obligation bond? And do they need to build a seawall, for example? Is that actually one of the mandatory uses of proceeds from that bond? And then you actually begin to see a correlation where it is directly tied, the performance of that bond, credit performance of that bond is directly tied to Miami actually using the proceeds for resilience measures. And we begin to integrate these metrics, and so that one, they are more correlated, and two, the actual ESG impact, or in this case, the E impact, and there's actually probably a knock-on effect to an S impact to the broader Miami community, is quantifiable and is then measurable over time. So that's one example. And the bigger thing is, or the infrastructure for that is then how are we taking in that information? How is that information being made available to all stakeholders, from an originator, whether it is Miami or an issuer of residential solar ABS, to the rating agencies who are helping evaluate it, writing research on it, writing pre-sales on it, to the bankers who are communicating, who are modeling around these risks, and ultimately distributing them to the investors. And then how are the investors measuring this and monitoring it for investments that they own or investments that they're considering buying or selling over the next couple decades?
Great, thanks, that's fascinating. Mook, would you talk a little bit about what you're seeing from the CLO perspective of late?
Sure. Here's what's interesting. I think on our side, with the loan and CLO perspective, we've worked closely with our sustainability finance team about, where the investors come from, who are the investors who've signed on with the UNPRI, and who has specific ESG mandates. Now, what's interesting is that we've focused on 3 major regions: US, Canada, and Europe. Let's start with Europe first. It seems like the preference in Europe for how they will satisfy ESG criteria is exclusionary criteria primarily. In other words, avoiding certain sectors: gambling, oil and gas, nuclear weapons. What's really interesting with that approach is, and Ash kind of alluded to this, is that the investors are really driving what the mandate is. And I think the biggest question mark we face right now in loans and CLOs is, how do we become ESG compliant? I'll say right off the bat, the avatar it's taken right off the bat is because the European compliant way is kind of, the European satisfaction of that criteria is in some ways simpler. When you're talking about a loan, it's pretty straightforward. Obviously, you do a diligence on the corporate. But when you're talking about a diversified portfolio of loans, which is what is backing a CLO, the question becomes, how do you measure that? And now, all we've seen so far is we've seen a handful of European managers and a handful of US CLOs that are European risk retention compliant, basically place into major bids in the AAA and the equity level in CLOs, and it's primarily based on exclusionary criteria. Pretty straightforward to implement, and we've seen a handful of deals work that way, and there's a pretty good bid for that as well. The more interesting question is, once we've taken that canvassing exercise to the US and Canadian regions, we've actually seen a desire not for an exclusionary approach, but more of a positive ESG scoring type approach. So that kind of begets kind of almost an iterative problem, because the question now is, what do investors want to see on that front from an ESG scoring perspective? and how do managers address that? And then it comes into question about the reporting, third-party validation. Is it a rating agency? Is it someone else? So I think that's one of the biggest question we have to address in terms of CLOs as it relates to US and Canada. On the back of that, I will say the easier way to kind of address that in the US and Canada is going to be loan SMAs, separately managed accounts, because it's kind of easy to source a smaller portion of the loans for that purpose. And if the mandates and the ESG methodology that a specific investor wants to see varies from one to another, it's going to be hard to standardize that. But in the immediate short term, we already know of a handful of managers that are ahead of the curve in terms of scoring their portfolios for ESG. In fact, most will tell you that they have already been incorporating their ESG factors into their credit process. So it's a mere formalization of that process for the sake of the investors. And I think from that standpoint, we've seen some SMAs being opened up. What's also really interesting is that the trade associations have kind of stepped up. So the LSTA has come out with an ESG questionnaire that they've broad-blasted to managers in terms of trying to figure out what it is that managers can do on that front. And we've also had another big development in the loan space was the SLLP rather, the sustainability-linked loan principles that all the loan trade associations in different regions came out with together. That will also help drive the guidelines for how you issue those loans. I think that's going to be a big part of it, and I think the trade associations have really stepped up. But I think on the US and Canadian front, we'll talk about this a little later, but addressing how we create a positive ESG scoring methodology for managers and standardizing that across CLOs is going to be a big question going forward.
Great, thank you. And that's your observation around the progression of the exclusionary point of view to a more active and selection-based approach is interesting. So we've touched on E a little bit, and we've touched on social a little bit. Jim, would you talk a little bit about the governance aspect and how you view ESG in structured finance?
Sure. First of all, I would like to applaud all of you guys for being here. There's going to be $1 trillion of deals done between now and this conference next year. It's a lot of volume of financing. But for whatever reason, you all have come here to figure out what you can do to empower change. And I think that's what we probably should remember, the goal of ESG. It's not necessarily a tick the box, but rather how can we empower people to do better things with our leverage tools. For those that may or may not know, there's an organization that I know we've been talking with SFA about called PRI, Principles of Responsible Investments, based out of London. It was originally affiliated with the UN, and there was a discussion about how are the pension and endowment and some of the sovereign wealth funds sort of spending their dollars, and are they spending it in a way that is not really helpful to the planet long term? And it's been an organization that meets every year. I've been to Berlin and San Fran, I think. We got Paris, Tokyo this year. Hopefully all these important travel restrictions hopefully will be resolved, importantly, for all those people involved. But what the goal that came out of it was ESG. And how do you think about creating positive influence? And it mostly was a corporate thing. In other words, how's a corporate act? What's their goal? What is their footprint in the world? We're the ones that just provide them leverage. They commit equity, they undertake a project, and then through structured finance products, we provide them a lot of leverage and they get to go do it again. So we actually, as an industry, could be an incredible catalyst to make some really big strategic moves as those equity folks that we may or may not buy their stock on do it. Well, we're on the governance side, and we're on the governance side on that financing product, not on the equity itself. But interestingly, I saw one of our clients that walked in here. She actually lives on a farm, a family farm on the weekends. This is probably one of the smartest Wall Street bankers I know. She lives on a farm, and I saw her walk in here a minute ago. I saw another person a few minutes ago walk in here that I know spends 1 day a week at a food shelter. There's something that goes on in your heart that wants you to try to make change. And our job, like I said, is to build responsible investment products that these smart people can go out and buy in hopefully $1 trillion size. So hopefully next year at this time, we're going to have more. But as we do our business every day, we start to get caught up in what worked yesterday is probably going to work tomorrow. So I have a question, and I don't need people to necessarily raise hands, but how many people know that probably the most amount of panel discussions on this whole weekend that we're here, week, is about LIBOR? How many people know about LIBOR challenges? Bunch? Okay. So imagine a deal that was done last week. Now, this is not legacy. This happened last week. Let me cite a sentence. LIBOR, as defined at 11 o'clock in the morning London time, other than on bank holidays, London bank holidays. What's the matter with that sentence? The matter with the sentence is that we are probably, a decent chance, going to move to a US index called SOFR. That index, we are closed in the United States on Martin Luther King Day, 4th of July, and Thanksgiving. What that issuer put in the deal docs is that we can only use the index based on London bank holidays. They're closed on Boxing Day. So we have, right out of the box, drafting challenges. So we are being compelled to jam a US index into a UK holiday schedule. This happens a lot. The average deal that we look at has 35,000 pages of documents that we have to figure out whether the governance of them links between the loan collateral and the bonds that you buy. It is an incredibly large amount of unstructured data that we have to read the documents and figure out where the implementation holes are. The story of the day is LIBOR. We as an industry have this opportunity to improve transaction documents, improve the governance, not necessarily make it harder for the participants, but to make sure that we build the best leverage tools so that those equity people can make the positive difference. So the governance is really about knowing how it's all put together, and I think we as a trade association have great opportunities to stabilize a couple of things. We happen to be involved in it, but we can make a very positive impact as people sitting in this room today.
Right. Thanks, Jim. And you touched on an interesting point, which is the expectations for huge amounts of increased issuance on the ESG front. So I'd like to turn our conversation for what folks on the panel think are the emerging opportunities, whether it's new asset classes or the redefinition or repositioning of existing asset classes to become sort of an ESG focus for investors. Ash, what do you think are sort of the obvious and also less obvious candidates on that front?
The obvious ones that are already out there: solar ABS, PACE product, although it's going through some kind of changes on the regulatory front, so it's still an evolving kind of emerging story there. Away from that, there's commercial PACE, there's EV kind of driven auto ABS. Those are the ones that are already out there. I think there are some others. In general, I think away from that, if you look at the example that I like to use is if you look at kind of what's already out there, you can see a path. For example, if you're thinking about E, you can see a path to differentiating maybe one auto pool from another based on fuel economy or some other criteria that you want to use, but you have to figure out what you're going to kind of benchmark it to. Are you going to benchmark it to, the manufacturer's average kind of fleet fuel economy? Or are you going to differentiate it to what the Department of Transportation? But do you want to think about it that way? Because there's probably a few other ways to think about it. Other examples of a path you could go down if you want to differentiate one credit from another, for example, on the social aspect. There's a ton of subprime consumer credit origination that goes on in the economy, and they're all at different APRs. Do you have a way of thinking about whether you care about a 35% APR pool or a 50% APR pool versus a 10% APR pool that's lending to people who might not otherwise get credit? How do you think about that, and how do you frame up that social conversation? There's other examples that are out there, but these are trades, these are credits that are already out there. And then based on what some other people are doing away from securitization, they might see, for example, that's getting in that kind of behavior, certain types of behavior, getting incentivized in structured products. And those those sponsors might decide that securitization is actually a good place to go.
Great. And Luba, can you sort of give your perspective on that question from a CMBS perspective?
Yeah, absolutely. So CMBS, commercial real estate, I think there's tremendous opportunity to really issue some impactful product. And kind of like if you think about it on two sides, right? One is building constructed, more efficient commercial real estate. So LEED certified buildings, a very easy, obviously, story to tell and easy green bond to issue. Second, and I think bigger part where there's a lot of work could be done is to making existing real estate more efficient. So obviously, I am in the agency CMBS, that's what we do, we're trying to make it more efficient, but if you think about it, every subset of commercial real estate, there is so much more potential. When we speak to our borrowers on the equity side, actually a lot of them already do a lot of work to make the real estate efficient because it's just a good real estate decision. Like if you zoom in, for example, New York office market. I'm in a building right now who is going for a major construction to be qualified as a LEED certified building. I mean, that's kind of what the tenants demand. And I think that's a great place for CMBS to step in and provide debt on this kind of transactions to help to do some of those improvements. So I think a clear labeling of green in that kind of circumstance is very important, and obviously reporting on the impact and use of proceeds is a big part of it.
Great. Benji, are there any sort of, not necessarily asset class specific opportunities, but do you think there are any other structural or other opportunities for growth when we look at investment opportunities from an ESG perspective? What's your take?
I'll answer the question from a perspective that there's tons and tons of demand for this, and that there are some market structure things that need to happen for the opportunities that do exist to become investable by that broad swath of demand of investors who are here. And I'll look at a few different examples of this. So it was just over 2 years ago, TRX was used to facilitate the first commercial PACE, property assessed clean energy securitization. And since then, there have been, I think that in the last year, or this year, the market will be 20 times as big as that. And so, what happened for that to happen? We had a securitization that was done in a way that was rateable, firstly, and then investable, and it was actually structured in a way that looked like more mature asset classes than a first-of-its-kind deal. And this, to exactly Luba's point, this made commercial property assessments and property improvements more available to the institutional investor market. More money can flow in, and you get a nice virtuous cycle out of that. To a market that Ash touched on, you have the solar market. Yes, there's solar ABS that's doubled 2019 versus 18 in terms of 144A transactions, but so much more of the paper is now being bought in whole loan or private markets. And so that market has grown tremendously as investors have become more comfortable, as there has been more standardization of the underlying collateral, as well as the ways that that's being packaged and then evaluated on an ongoing basis, again, with standardization of data and actionability of that data. And then the last one, which is burgeoning in the S sphere of ESG, is affordable housing. Banks have been mandated to do more affordable housing lending in areas where they're getting tax credits, and have now actually realized that this is, one, a securitizable asset class, and two, a very attractive one. And so, again, you can see a bit of the market infrastructure coalescing around it and creating more investment opportunities.
Great, thank you. And Mook, from your perspective, looking at the loan market, which is very broad and in some ways unlimited, what are you seeing or what are you looking for?
Sure, I think, like, listen, I think the development of the sustainability linked loans is going to be very important to that side. I think the bigger challenge is we have a lot of our CLO investors asking us, what does it mean to be ESG compliant? And so in the exclusionary standpoint from the European side, it's pretty straightforward to answer that. The big challenge we face right now on the US and Canadian side, and I think this does have massive repercussions for our market, is how do we get US, CLOs that want to have a kind of investors who want a positive scoring system and ESG methodology around their portfolios, how do we get that done? Because the conundrum we face right now is you have investors who are like, I have a need, and I basically want to put that money to work. And then CLO managers are asking, well, how do I address that need and what do I need to do? And so it's kind of an iterative problem, and it's going to take some iterative problem solving, to be completely honest. Like I mentioned, there are a handful of managers that already have a positive ESG scoring system, but I think what's going to help is, arrangers like us working with investors that we know have a need, with managers who understand credit, who can figure out, how they can build their portfolios and how they can score those portfolios on an ESG basis, and along with some of the third-party vendors to the extent that's important to the investors, like whether it's a rating agency or a data provider. And I think it's going to take all three of those elements to kind of come together, work, kind of almost iteratively problem solve with investors to figure out how do we address this need. And that's something that we've been working on with our manager partners quite recently on doing, which is to basically say, listen, this is the methodology we have in place. How do we address your needs, and does this kind of get us there? And what would it take to get the ESG methodology on sides for you to feel interested in investing in this as a product? And I will say this: I think we've had some conversations with investors in Canada that have basically said, listen, we've never looked at loans, we've never looked at CLOs, but we have an ESG axe, and to the extent there is the ability to address this via loans through a diversified pool of loans that's managed, we would take a look at it. And so what is interesting, this is, I don't know how many people here are have invested in the CLO market, but I will say that anytime investor depth has been good in our market, it has driven pricing, it has driven the arbitrage in our deals. And I think what ESG also has the potential to do, other than obviously all the social impacts that we all care about, is the ability to bring new investors to the fray and have them have access to a new asset class that maybe they haven't looked at before. And I think that could have very good repercussions on the loan market and the CLO market, and so that's something that we're very focused on.
So I think that's actually a pretty interesting point, right? Because one of the things that we've been talking about is kind of how's the supply side going to change, and but part of the discussion actually is that there are investors who've never really looked at structured products, but if you can show them an ESG focus, then actually you can support the expansion of the structured products market because you can draw new investors who've never done it before, and you can get them to look at it and potentially buy a product. So I think that's interesting.
So I want to touch on or turn the conversation to hurdles. Some hurdles and different challenges around growth and in ESG have already been identified. Ash, what do you think are the most crucial hurdles that we need to tackle? Impediments.
I think probably the type of conversations that we're probably having with the street and sponsors that we meet with, at least just kind of as part of the investment process, those conversations are around, well, is this a green bond? Yes. Okay. Do you have anything that tells us, like, from a third party that's a green bond? No. Okay, well then can you give me some information so I can do it myself? No. Take my word for it, that kind of thing. Well, I can't turn around and tell a client that we're calling this, it scores highly on ESG and it scores highly on impact, but I don't really have any information to show you. So we're sort of dealing with that part of it. I think the challenge is that there's so much liquidity in the market, which is good, but at the same time, it also doesn't particularly incentivize sponsors to kind of want to work with you on these little issues that are incrementally more work for them. When they sort of look at the market and say, I'm getting pretty decent execution, it's not worth it for me, so I'm not going to do it right now. So I think that's some of it. I think that if we can get traction there, we probably can get we probably can get sort of some more build out in the ESG conversation. And then I think everybody, it's such an early stage that, you know, I guess most asset managers are still kind of iteratively, to use your phrase, iteratively talking to clients to try and figure out what it is exactly that they're looking for. And as the discussions kind of keep happening over and over again, you kind of get a sense for it. I would say that and then it's just that sometimes there's a returns, like a return and yield kind of challenge, like relative value challenge, which is in a lot of instances there is this kind of technical in some products that have this kind of impact characteristic to it or an ESG characteristic to it. And sometimes when the street comes to sell it, there's a pay up for it, and the feedback that we get from our investors is we don't want to compromise returns to get this either. So that's an additional challenge, and I'm not really sure, you know, who wins the immovable object or the irresistible force. It kind of feels like sometimes that's where we are at this point in the cycle. So sometimes you have to wait for some volatility to kind of hit and some dislocation so that you can, from an investor standpoint, kind of use the leverage that you have and kind of reset or try to get some traction on some of the things that you're looking for. But, you know, the last time I got to do that was probably 2010.
So to address that challenge of data availability and accessibility, Luba, I think you have direct experience, right, with providing that data to the marketplace. So can you share a little bit about?
Yeah, absolutely. And actually, great point, because I think since green bonds, social bonds, sustainability bonds, very hot topic right now, there is no, you do not have to apply somewhere to use the word green when you issue the bond. You can just issue it. So I think some of the issuers may be jumping on that train and issue it. And that's where the scary part comes in, this greenwashing thing that recently in the news was popping up. I think the biggest part when every time you issue the impact bond is actually providing appropriate data that will be showing that there is some kind of an impact happening because of the issuance of that bond. So on agency side, it's kind of easier for us because we already been setting up a very robust disclosures and very thorough data collection. So we're trying to be as transparent as possible, obviously protecting some of the borrower's personal information. So it was easier for us to report on it. And we're in the process of putting together our first impact report. And yet it was still challenging because you do need to have certain processes in place to collect it. So fortunately with our green loan program, we had that all the utility data needs to be put into the Energy Star portfolio manager, so it was easy for us to grab it and collect. But you need to have a big network in the back end that will be collecting all this data and putting it together. So I think anytime the issuer will be thinking to go forward to issue some kind of impact bond, you really need to think about this second part, which is really important.
Great, thanks. So we're close to time, but I'd love to get some final thoughts from our panelists on whatever you think is the top most important priority and item that in terms of the structured finance market being able to accelerate adoption of ESG, whether it's from an issuance perspective or an investor perspective or other market participants, what is the most fundamental thing that we need to work on and focus on as a market in order to get there. Jim, can I start with you?
Sure, I'll try to make it quick. It's all about the sustainability of our whole market. I talked about $1 trillion a minute ago. We just got to make sure this machine keeps working because we can empower a lot of really good stuff. But as you go, and again, we look at it from the perch of the governance folks, there are there's structures within these deals. They're not best in class. Now, there's ways that you can offset it through enhancements and other things, but really look at the way it's designed. And if you haven't read like an entire deal document, soup to nuts, go get one and read it on the airplane going home. These things change. They're changing substantially and not always in a great way. So find the issuers you like, work with the rating agencies you like, call people out, and make sure that we're all here with 3 times more people next year with more than $1 trillion being done.
Well said. Benji?
I think the most important thing is data standardization and centralization, picking up on what both of these guys were just talking about. There is no consistent means to get things to market or even agreement on what data should be shared. I've had calls with 2 chief sustainability officers at major investment banks in the last week, and they can't track just inside their own organizations what has a green impact or not consistently. And it is a massive, massive problem, and that's an isolated silo, let alone for the rest of the market. So data standardization, centralization will get us a very long way.
Definitely to echo that's very important, data standardization. And I think like overall, just kind of want to encourage still like every issuer actually look what they, at their kind of product type and see like what kind of impact that you can extract. And if, once again, I said this stupid analogy, recipe pie, right? Like if there's no recipe out there, kind of I would encourage everyone to look at closing, maybe create your own framework, and hopefully investors will like it, and that's how we can keep on going with this positive movement.
Yeah, I think it's information. I also think it's the nature of these types of conversations that we're having. If I think about how many conversations on this topic I've had in the last 6 months versus, the X amount of time before that, just even our own organizations thinking around the topic has made some fairly sort of rapid, has evolved pretty rapidly just in the last several months. So I think it's all kind of happening right now, and I think these types of this dialogue is actually what's going to help get it there.
Thanks.
All of the above. I think pretty much everyone, I agree with everything that's been said. I think the truth is we have so many, as Ash mentioned, like I think the predominant question we've had in every investor meeting up to this point has been ESG on the CLO side. And I think the biggest thing is going to be education, working to solve the problem together on how we address that need, and working with the third party, the data providers and the rating agencies to figure out how we get everyone comfortable with something that works.
Great. Thank you all. I know we're over time, but if there is a question or two from the audience, I'd love to entertain that. Go right ahead, yeah.
Yeah, I think I'll try that one. I think we already get that in some ways because we do have clients that are coming in and saying, okay, great, this is a great strategy that you have, but I want to do this part a little differently. And so they'll focus on one particular thing, or they'll say, in addition to that, I don't want to do this, or I do want to do this. So I think that's already happening. I don't know if it's going to be as focused as kind of what you said, but I also think that. But that's sort of on the impact side. I think on the ESG side, especially in structured products, it's sort of very, very nuanced, and you're not going to find out a lot of things about how your client feels until you put it in front of them, and kind of get their feedback, and then they'll say, well, I don't really care if I don't really, no offense, but I don't really care if the deal doc doesn't look very good. I only care because there's like, you know, there's 10,000 electric cars in this pool. So the deal doc doesn't matter to me. Like your client's going to tell you if it means I can't trade that pool, then I'm going to let the E carry the day over the S and the G. It's kind of what they decide they want to do.
Any other? All right. Thank you to the panel. Really appreciate it.